The world's most powerful financial system may be facing its most dangerous test, and it is unfolding at one of the most critical choke points on Earth. In recent developments surrounding the Strait of Hormuz, tensions involving Iran have once again raised alarms across global markets. This narrow passage, responsible for transporting a significant portion of the world's oil supply, is no longer just a geopolitical hotspot. It is now at the center of a potential financial shift that could challenge the very foundation of the global economic order. The petrodollar system. For decades, the petrodollar has defined how energy is traded globally. Oil transactions priced in U.S. dollars have reinforced demand for the currency, giving the United States unmatched financial leverage. It has allowed deficits to be sustained, debt to expand, and global influence to be maintained, not just through military strength, but through monetary dominance. But today, that system is showing signs of strain. The immediate trigger is not just military tension, but strategic signaling. Iran's position in the Strait of Hormuz gives it the ability, whether through direct action or implied threat, to disrupt oil flows that power economies across Asia, Europe, and beyond. Even the perception of instability in this region is enough to send shockwaves through energy markets. But this time, the reaction goes deeper than price spikes, because alongside the risk of disruption is a growing shift in how oil itself is being traded. Some nations are increasingly exploring alternatives to the dollar-settling energy deals in other currencies, building bilateral agreements and quietly reducing reliance on the traditional system. These moves are subtle, but their implications are profound. If sustained, they could weaken the structural demand that has supported the dollar for decades. This is where the financial and geopolitical threads converge. A crisis in Hormuz is not just about oil supply. It is about control. Control over pricing, over currency, and over the mechanisms that underpin global trade. And when that control is questioned, the ripple effects extend far beyond the region. Markets are already reacting with heightened sensitivity. Energy prices fluctuate on headlines. Currency markets adjust to shifting expectations. And beneath it all, a deeper concern is forming. What happens if this is not a temporary disruption, but the early stage of a structural transition? Because the collapse of a system like the petrodollar does not happen overnight. It begins with pressure points, with alternative pathways, with moments of instability that expose vulnerabilities long ignored, and now one of those moments may be unfolding. If you want to understand how a geopolitical flashpoint could trigger one of the most significant financial shifts in modern history and what it could mean for your future, subscribe now, because this story is just beginning. The foundations of the petrodollar system were built in the 1970s when the United States reached a strategic understanding with major oil-producing nations to price and sell oil exclusively in dollars, effectively tying global energy demand to the U.S. currency. This arrangement ensured that countries around the world needed dollars to purchase oil, reinforcing its status as the world's primary reserve currency and giving the United States enormous economic leverage. Over the decades, this system expanded alongside globalization, embedding itself into financial markets, trade systems, and central bank reserves. But beneath this stability, tensions gradually emerged as new economic powers rose, particularly in Asia. Questions began to surface about the fairness and sustainability of a system dominated by a single currency. By the early 2000s, some nations started exploring alternatives, though these efforts remained limited and fragmented. The real shift began to take shape more recently, as geopolitical tensions intensified and sanctions became a more frequent tool of economic policy. Countries targeted by financial restrictions began seeking ways to bypass dollar-based systems, developing alternative payment mechanisms, and increasing trade in local currencies. This trend accelerated as global conflicts intersected with economic interests, pushing nations to reconsider their dependencies. Against this backdrop, the Strait of Hormuz gained renewed importance, not just as an energy corridor, but as a strategic lever in this evolving landscape. Each escalation in the region, each threat to shipping routes, and each response from global powers added pressure to an already shifting system. The timeline is not defined by a single event, but by a sequence of developments, decades of dollar dominance, gradual diversification efforts, rising geopolitical friction, and now, a critical moment where energy security and currency control are colliding. This convergence suggests that what is happening today is not an isolated crisis, but part of a broader transformation that has been building over time, bringing the petrodollar system closer to a point of unprecedented stress. As tensions around the Strait of Hormuz intensify, the sequence of events reveals how quickly a geopolitical flashpoint can translate into financial disruption. It often begins with a military signal, naval movements, warnings to commercial vessels, or heightened patrol activity in the region. Almost immediately, shipping insurers reassess risk, increasing premiums for tankers moving through the strait. Some vessels delay transit altogether, tightening supply expectations before any actual disruption occurs. Energy markets respond within minutes, pricing in potential shortages, while governments issue statements that are carefully worded but closely scrutinized for intent. From one side, these actions are framed as defensive measures, necessary steps to protect sovereignty and ensure regional security. From the other, they are interpreted as coercive leverage, designed to influence global markets and political outcomes without direct confrontation. At the same time, financial systems begin adjusting in parallel. Oil-importing nations quietly explore contingency arrangements, seeking alternative suppliers or negotiating currency terms that reduce exposure to volatility. In some cases, transactions begin shifting away from the dollar, not as a dramatic break, but as a risk management strategy. This is where the financial dimension deepens. What appears to be a temporary response to a localized crisis may, over time, accumulate into structural change. Each transaction conducted outside the traditional system slightly reduces the dominance that has defined global trade for decades. Intelligence assessments often highlight the uncertainty surrounding these developments. It is rarely clear how far any side is willing to go, or whether actions are intended as signals or precursors to escalation. This ambiguity creates a volatile environment where perception drives reaction. Markets do not wait for confirmation, they move on expectation. And in that gap, even minor developments can trigger disproportionate responses. What makes this situation particularly complex is the overlap of motives. Strategic positioning, economic pressure, and political messaging are all occurring simultaneously, making it difficult to separate cause from effect. A military maneuver may influence oil prices, which in turn affects currency strength, which then feeds back into geopolitical calculations. The cycle becomes self-reinforcing. And as these layers interact, the system becomes more sensitive, less stable, more reactive to shocks that in a different environment might have been absorbed without consequence. This is how a regional tension begins to evolve into a global concern, through a chain reaction that connects energy, finance, and power in real time. What elevates the Strait of Hormuz from a regional flashpoint to a global strategic fault line is its unmatched importance to the flow of energy, and, by extension, the stability of the financial system built around it. A significant portion of the world's oil passes through this narrow corridor each day, making it one of the most critical arteries of the global economy. Any disruption, real or perceived, immediately tightens supply expectations and sends prices higher, but the implications extend far beyond energy markets. This choke point effectively links military positioning to financial influence. Control, or even the credible threat of disruption, becomes a powerful lever that can shape currency flows, trade agreements, and geopolitical alliances. From a financial perspective, the importance of this corridor is deeply tied to how oil is priced and traded. For decades, transactions flowing through routes like Hormuz have reinforced the dominance of the dollar, embedding it into the mechanics of global commerce. But as tensions rise, the reliability of this system comes into question. Nations dependent on these energy flows must now consider not just supply security, but also transactional security, how oil is paid for, in which currency, and under what conditions. This creates an opening for alternative systems to emerge, particularly among countries seeking to reduce exposure to geopolitical risk. Militarily, the region is equally critical. Naval presence, surveillance capabilities, and rapid response forces are all concentrated around this narrow passage, reflecting its importance to global stability. Any escalation here would not remain contained. It would draw in multiple actors, each with their own strategic interests. This concentration of power increases the stakes of every move, making even small actions potentially consequential. Operationally, the implications are immediate. Shipping routes can be rerouted, but at significant cost and delay. Insurance premiums surge, affecting the economics of energy transport. Governments may release strategic reserves to stabilize markets, but such measures are temporary. Over time, repeated disruptions, or even repeated threats, can encourage long-term shifts in trade patterns, infrastructure investment, and alliance structures. Taken together, this transforms the Strait of Hormuz into more than a geographic location. It becomes a pressure point where military capability, energy dependency, and financial systems intersect. And when pressure builds at a point this critical, the effects are rarely localized. They spread outward, reshaping not just regional dynamics, but the broader architecture of global power and finance. According to intelligence assessments and leading geopolitical analysts, the growing tension around the Strait of Hormuz is being closely monitored not just as a military risk, but as a potential inflection point in the global financial system. Experts at major policy institutes warn that repeated disruptions, or even credible threats, could accelerate a shift already underway. The gradual move by some nations to reduce reliance on dollar-based energy trade. This is not happening through a single dramatic decision, but through a series of incremental adjustments, bilateral agreements, currency swaps, and regional trade frameworks designed to bypass traditional systems. Analysts emphasize that while the dollar remains dominant, its strength depends heavily on continued global demand, particularly in energy markets. Any sustained erosion of that demand, even at the margins, could have long-term implications. Military and security experts add that the strategic use of choke points like Hormuz introduces a new layer of economic warfare. By influencing the flow of oil, actors can indirectly impact inflation, currency stability, and economic growth in countries far beyond the region. This creates a form of leverage that operates below the threshold of direct conflict, making it both effective and difficult to counter. Intelligence reports often highlight this ambiguity. As one of the most challenging aspects of the current environment, actions can be framed as defensive while producing strategic economic effects. Financial analysts also point to the role of central banks in navigating this uncertainty. In response to rising geopolitical risk, some institutions have increased gold reserves, diversified currency holdings, and adjusted policy frameworks to account for potential disruptions in global trade. These moves, while precautionary, signal a recognition that the current system may face increasing strain. At the same time, experts caution that transitions of this scale are rarely linear. Periods of apparent stability can be followed by sudden shifts, particularly when multiple stress factors, debt levels, inflation, and geopolitical rivalry are present simultaneously. Academic perspectives reinforce this view by drawing parallels to historical periods where dominant financial systems faced emerging challenges. In those cases, change was gradual at first, often overlooked, before reaching a tipping point where adjustments became unavoidable. The current moment, they suggest, may represent a similar phase where underlying dynamics are shifting, even as the surface appears relatively stable. What unites these expert views is a shared understanding. The situation in Hormuz is not just about regional security, it is a signal of broader structural pressures building within the global system, pressures that could reshape how power, trade, and currency interact in the years ahead. But there is a competing perspective that challenges the idea of an imminent petrodollar collapse. Some analysts argue that despite rising tensions and gradual diversification efforts, The dollar's position remains deeply entrenched and far more resilient than it appears. They point out that global financial systems, from banking infrastructure to debt markets, are still overwhelmingly denominated in dollars, making any rapid transition both complex and costly. From this view, recent moves by certain countries to trade oil in alternative currencies are not a coordinated shift, but rather limited, strategic experiments that coexist within a system still dominated by the dollar. Diplomatic experts also emphasize that even in times of heightened conflict, major powers have strong incentives to avoid destabilizing the global financial architecture. The costs of a sudden breakdown would be too high, not just for one country, but for the entire interconnected system. As a result, behind-the-scenes negotiations and informal agreements often work to contain escalation even when public rhetoric suggests otherwise. In this sense, tensions around Hormuz may function more as leverage in negotiations than as a direct path toward systemic disruption. From a market perspective, some economists argue that fluctuations in energy pricing and currency usage are part of a broader cycle rather than a structural break. They highlight that similar concerns about the decline of dominant currencies have emerged in the past, yet the transitions when they occurred unfolded over decades rather than years. According to this interpretation, what is being observed now is an adjustment period, one where multiple systems operate in parallel without immediately displacing the existing order. There is also the argument that the very strength of the dollar lies in its adaptability. U.S. financial markets remain among the deepest and most liquid in the world, attracting capital during times of uncertainty. This safe haven status can, paradoxically, reinforce dollar dominance even as geopolitical tensions rise. Investors seeking stability often move into dollar-denominated assets, offsetting some of the pressures created by diversification efforts elsewhere. This alternative view does not dismiss the significance of current developments, but it reframes them. Instead of signaling a collapse, it suggests a gradual evolution, one that may reshape the system over time without triggering a sudden breakdown. The challenge, then, is not predicting an immediate end, but understanding how incremental changes could accumulate into a different global financial landscape over the long term. And in that slow transformation lies a different kind of risk. One that unfolds quietly, without a single defining moment, but with consequences that become clear only in hindsight.